Stocks are crashing, markets are in turmoil, and bonds could be showing us massive warning signals. Hello, ladies and gentlemen, and welcome back to the special weekend edition of Stocks, Commodities, and Cryptos around the world. With price action starting to show that the leaders are now laggards, what exactly is going on? Technology is selling, the S&P 500 had a horror weekly close, and it took out many people's stop losses. Are we heading for a new low? Well, obviously, with the volatility spike, we need to break down exactly what's going on with the options market, dark pool liquidity, and more importantly, the data moving forward. And while certain markets that we've liked this year are still doing really well, are they even starting to reach too much? Let's go through it right now together. This one's not to be missed, guys. We'll see you in a moment. Well, welcome back everybody to the special weekend edition of The Daily Show. My name's Tom, and in today's video, we're covering the latest macro, the data, and of course, the key levels that you need to be watching right now. We've got a lot to share, so let's get into it straight away, starting off with bonds markets. As you guys know, the bonds market is incredibly important, and it's just reached a 2025 high in all the bad ways. Maximum fear for this year has been achieved. Now, what this means is basically there is a certain level of bond market terror when it comes to these tariffs, Liberation Day, and whatever's going on in the markets right now. And it seems like the bonds market is starting to play a little bit of catch up to what has been a pretty big sell-off. Now, does this mean it's all over and the market can't recover? Not exactly. Of course, it's very important whenever you're looking at a statistic like that to put it in relative perspective. And that's something we love to do here on the channel, which is to bring it back to actually what makes sense at the time. If you like that type of common sense attitude, make sure to subscribe and smash the bell icon. So let's get it right here. Is this a sign of potentially a new low that could be forming? Yes, it is, and we'll explain that throughout today's video. But it doesn't mean that the market is completely freaked out. It just means that it's elevated on any other period of 2025 so far, and of course, that it's starting to show those signs of a pretty decent level of fear. Whenever we see this spike, we're looking for the turn point, and of course, we will be tracking that, and we have been, of course, so far. But it's coupled with a couple of other problems. Number one of those is the futures liquidity. Liquidity's been dropping quite consistently this year, which is totally different to what we saw in 2023 and 24. And although we have seen a couple of spikes in liquidity, we haven't seen that maintained liquidity that we like to see in the markets to really get things fired back up. Now, the last time we saw liquidity this low, yep, you guessed it, it was some of the big sell-offs that we've had over the last couple of years. Yes, we had the, of course, Silicon Valley Bank crisis. We've also had the July-August crisis of what was going on with the yen and the Japanese central bank. And of course, we are here right now with, I guess you would call, the tariff policy kind of crisis. Now, why is this important? Well, this has been the exact turning point, or very close to the exact turning points for previous liquidity injections. And as we've talked about before, the Federal Reserve in particular has already kind of said, well, you know what, we're going to pretty much end QT. And to me, anyway, that means that probably QE is just around the corner. You've got to remember there are two puts. One of those is the Federal Reserve, which is basically just print money, make sure everything kind of is stable and provide liquidity. And the second put is literally Trump backing down on some of the tariffs and some of the things that are going on. Now, this is what I thought was a really interesting chart, and you guys can let me know what you think in terms of the comments down below. Now, obviously, 2018 tariffs are not the same as 2025 tariffs. We know this, there's way more this time, and of course, more concerns out there. But at the same time, at least for this point in the year of tracking them, what you might notice is the last chart, which we've been sharing recently, actually had its bottom on April the 2nd. Is that kind of some kind of weird coincidence or something? Why have we got April the 2nd twice? So April the 2nd was actually the lowest low for Tariff 1.0. And as we've been tracking over on our X account as well, you can see here that Trump tariffs 2.0 versus 1.0 is actually kind of similar in some ways so far. Obviously, that resurgence that just came through in Tariff 2.0, which is that little buy that we saw, has now come back down to these levels. But what if we form a new low, hit some levels that we'll talk about in today's video, and then find a bounce? Could we actually be following a similar path? And yes, I know that path goes bad later on. And some of the reasons why that could be is actually a sugar rush into earnings based on the tariffs themselves. Remember, what are tariffs? while they often make businesses buy a hell of a lot of inventory very, very quickly. And of course, on top of that, they may also restructure their businesses. If you're restructuring your business, you're often firing staff. And although that is not a good thing for us, the workers out there, it is a good thing when it comes to corporate tax, corporate profits, and everything else that's going on. So there are some important factors to consider here. Of course, someone like Tom Lee, who is perennial bullish, and a lot of you guys in the comment section have many opinions on this, has popped out this article here. And I thought it was interesting to go through this, as I do agree with some of the points in terms of they are worth considering. One of those is, of course, the April the 2nd Tariff Liberation Day concept, and of course, the fact that the market is selling off into this event. Now, in many ways, what is that? Is that a sell the rumor, buy the fact in terms of the market predicament? Everyone has got maximum fear. We know this with sentiment reports, which we have a few stats on in a moment. And we also know that recently we talked about a 6 of 6 time where in similar situations where we saw breadth do what they did, which is basically a 90% and an 85+% breadth increase, we usually saw a new undercutting low followed by a rally. Now, that's a very important point because that's the kind of point that we're getting up until. However, there are some problems with this. We need rallies and we need them in the right sectors. Have a look at this. The S&P 500 versus information technology. Information technology stocks actually are dropping to new lows. We've already hit a new low on both communication services, infotech, and other markets, including semiconductors versus spike, attaching those lows, all coming into this week. And that shows us that there is risk off across the board. And that's a bit of a problem because we're seeing that in some of our other favorite indicators, such as the American consumer, XLY versus XLP, etc., which basically tells us that the market has been turning defensive. Now, this is one of the reasons why in 2025 we've been so bullish on gold, silver, China, and of course on healthcare as well, and the reason, and utilities. And the reason is quite simple. We had an expectation that this year was going to be tough because it didn't matter what chart you were looking at, even if you were looking at correlation third-year bull markets, they tend to be something like this, which is up, down, and all around. The other problem is we expected tariffs, and on top of that, we expected just a mid-cycle into late cycle style slowdown. And unfortunately, that is kind of what seems to be happening here. Now, can we get a bounce? Well, as we mentioned before, 6 of 6 times that we saw similar bounce style characteristics as we've seen recently, the market would undercut and then it would generally recover past that point. We also know that whenever we see these stats, it's not unusual for the next couple of weeks to be a coin flip at best or even heavily negative. In fact, I found some stats that would show only 25% of the time after the breadth stats, after things that we've seen recently, where markets were going to be bullish over the next 2 weeks to 1 month. Now, why is that important? It's because every single 2 month and 3 month stat that we look at similar to this seems to have the market recovering back. And a lot of people say, oh, but look at 2022 or look at these other markets. You've got to remember, upon their first sell-offs, they rallied, they dropped a new low, they rallied, and they found themselves around here after that 2 to 3 month stat. And why that's important is because it means that we can be pretty clear that at least at this stage that we expect an up and down and all around, if not neutral market to bullish market. And that's important because, of course, if it starts to go more negative, that's then following what we call the recession path. We will have a special coming up this week on recession paths and, of course, where we're up to right now on that, because as you guys know, the next month and a half, the structure matters. Now, what about the Russell 2000? Have we seen an extreme oversell? Well, 1,708 Russell 2000 stocks fell on Friday. That's the highest level so far this year. It's actually the worst breadth sell that we've seen on the Russell 2000. On top of this, we've got conference board 1-year expectations, 2-month net changes in general being absolutely epic towards the downside. And a lot of these can be seen as counter kind of intuitive. So basically people see it as a scare. It is a scare. There's no doubt there are problems in this market, but people say, well, wait a second, should that bearishness be considered bullishness? At some point, it really should. Remember, if there's fear in the street, you want to be starting to think, well, maybe this is a buying opportunity. On top of all of this, we also have certain correlations with previous markets. This is one that we've shared recently, which has been the NASDAQ comp 1,000 days over the top of kind of where we are right now. And what you'll notice is the market has been following a very similar path. And in fact, this was actually a scare similar to what we saw during the dot-com boom, followed by a big rally. Now, time will tell whether that's going to be correct or not, but it does make sense to seasonality. And one of our favorite stats is back, which is Wayne Whaley over on X. And he's gone through and he's found during his January barometer, which as we know, January has a great read often on April's in particular. It shows us that, what happened, which was compliments of a 2% January at basically the point here of April, we are seeing some incredible stats towards bullish action. In fact, up to down ratio, according to his move overall, was 29-4. And with 2% moves in Jan, it looks like it's, I'm not sure about this, but 100% stat. That is that 2% moves in April in this 2% January setup were 18-0 to the positive side. So that is an incredible stat. Even if we do make new lows, guys are going to have to be looking for dark pools. We'll have to be looking for buy signals. We'll have to be looking for changes in trend. Because if this is true and it does come to pass, it's a pretty incredible stat. Now, of course, like any stat, there are problem ones. And this is definitely the one that I would keep in the back pocket. I've already suggested that you do not forget this stat. And this is the one that has to do with the 200-day moving average on the NASDAQ. Remember, what has happened recently is the market has sold off. It is closed underneath the daily 200 moving average, one of the best moving averages out there in the market. It further sold over 3.5% in like one session. And then it rallied back to the 200-day, which is an excellent take profit target. We talked about this quite a lot. Then it's since sold below that, come back down to these lows. And of course, some technology stocks are still lower. Now, the problem is the way that it's acting so far is very similar to 2000, 2008, and 2022. And we have to keep that in mind because remember, after a interest rate cut like we saw last year, it opens up the idea of a potential recessionary path or a soft landing path. And at the moment, we don't know which one we're on because, of course, we are at that inflection point. When it comes to things like the AA sentiment surveys, we already know that we've got consecutive levels of low bulls, high bears. And traditionally, if you look at stats, again, this was a counter argument that was basically it's so bearish, we should be looking at buys. Same thing when you're looking at incredible fast-paced sells. That's what we had. We had the fifth fastest, equal to a few of the other markets, sell-off of all time, and that often does bring the bulls, but you've got to be patient. The undercut of the low is not an unexpected thing to occur overall. Now, did we see anything good on the dark pools? Not really. I mean, we saw some bad signs actually on Friday. We were talking about this gap fill zone having one of the largest trades on it only recently. That got lost in the morning trade. And of course, we ended up undercutting all of these stop losses after the close and closing on that. So that means that we actually closed on the lows or near the lows versus, of course, finding a nice wick purchase up. And it does generally suggest that there is more selling to come when you're looking at these types of markets. On top of that, we saw one of the largest trades that we've seen on semiconductors, which could still be a buy, by the way, but it's not unusual for the markets to still undercut. Remember, they don't have stop losses like you and I. They don't trade like generally retail traders do. They position into the markets. And that's why we created a course called the Advanced Course, which has the reasonings for why we got into gold, why we got into China, why we get into defensives now, utilities, and certain markets when we've done them, because it is a replicable approach based on positioning more than necessarily based on something like, a traditional stop loss where you get smashed. Because the problem with that is that if you don't know how these markets build liquidity, you can get into some significant problems. And I'm sure we've all been there. We've got a flash sale on that at the moment as well. By the way, links in the description down below if you find that interesting. Let's now talk about rotation. Wow. Defensives back up again, of course. Most of the market was down through the session. But the key here was really consumer discretionary, communications, semiconductors, all of those were down across the board. On top of the overall 5-day move now, semiconductors, tech have really taken a beating after being the best performers 5 days before that. And it's been more of the defensives coming through the market. So basically at the moment, you would have to say the market is risk off and of course getting more risk off by the day based on what we've been seeing in the sells. Now, because the S&P 500 was coming near to the close, you'll see here that it kind of starts to revert some of the good news that we had. Some of the good news was that we gapped up. We obviously saw the mag stocks in particular do better, and we held that weekly 50 moving average. Now, we've so far just dropped that in some ways by closing below, and it does expose new lows being formed. In particular, it exposes two levels. Here are the options high lows for Monday, by the way, but the most traded level, which is 54.75, coming through this kind of area in here. And of course, the 5400 level. And it's very important that the market holds these zones. This bounce or this bounce would be absolutely fine. You might think, well, wait a second, that is absolutely terrible because we're making a new low. Well, yes, I mean, Tom Lee doesn't believe there's a new low that could come. But that being said, this is just where the most traded level was through this build-up accumulation. And this is, of course, the most common stop-loss hunt area that we could think of in the markets right now. And both of those will still hold overall bullish structure to the markets. If we start to lose those, then any rally may have to be considered just a full DCB, and basically you'd have to look at dumping it. It could also put us on the recession structural path. And of course, most people don't want that. A few of you guys in the comments, you guys want it. You know who you are. I absolutely understand both sides. Of course, it's always cool to be right either way. Now let's have a look at the S&P 500 for Monday. We've got, of course, a little bit of information here. 55.70 seems to be the major put wall. We saw a cascade effect as the markets took 56.50 during, of course, the Friday move. And as soon as that happened, we went super negative gamma and basically started wiping out people's levels. Now, you will know there are a lot of options at several levels here. 5,600, 5,500, all these levels. There's just puts everywhere stacked on these zones over the next month. And I think more importantly than any of this, we notice here as we go through this week, that is the 0 DTE options, there seems to be two lines in the sand. Above current price at around that 5,620 kind of area, and then a lot of 5,400s. So I wouldn't put it out of the case that we could hit into the 54s this week. But the thing is that things can change just like this. So really, it's one of those weeks where if you are already selling, okay, you might be pretty happy with yourself. But if you're looking at buying more, I would probably be looking for an actual bid to come into the markets. We have not seen a bid through this pullback properly. We've just seen kind of like nothingness or very, very weak bidding. We know they're dark pools, but we haven't seen the action to really go with some of those other than when we were talking about 5,500, 5,550, which we thought was a very good buy only a week or so ago. And some of you may have taken some profit off. Some of you are probably just sitting there holding it saying, I hope this turns around, and rightfully so in many ways. Let's now have a look at Tesla. It's in the middle of nowhere land. As you guys know, 250 is the put level and 300 is the call level. And of course on Nvidia, one of the most important stocks, it held around 110. Now, why is that important? The puts are there, 120, 125 is where the calls start getting into Nvidia, and it's still kind of trading within just holding levels. And you might say, well, wait a second, it's kind of suffering. It is, but it's not quite at the absolute new low. This is bad. What the hell is going on right now? Now, as we mentioned, and this is 1 day out of date, so this is actually now at an all-time high or new high for this year, which is that the bond spreads are really accelerating up. Now, the unfortunate truth about bond spreads accelerating up is it basically can signal that there are still lows to come. So that is kind of a worrying sign. Bond spreads going up, you usually want to be buying as they're dropping off, which of course is what we saw before making that kind of good level the other day. I mean, if you actually have a look at the dates here, we saw it drop off as of the 14th of March. So the drop off was the 14th of March. Now it's accelerating back up again, and that could signal a new low is coming. American consumer, XLY versus XLP, obviously not a great sell-off here for market bulls, and the VIX spiked again. Now, if the VIX keeps spiking, new low is formed. Obviously, VIX could accelerate back into the 25s. It will be worthwhile watching the VIX because, as you'll notice, the VIX actually started moving down as we started to see consolidation last time and the bonds market starting to show a little bit less fear. April the 2nd, it's going to be a very big day because in some ways it is exactly the same date as 2018. So there's going to be a lot of money, I think, looking at that stat and trying to figure out the flow moving forward over the next 2 days. Is it a sell the rumor, buy the fact? What do you guys think in the comments down below? Let us know. US dollar dropped off the daily 20, which obviously is where we thought there'd be a bit of resistance. And some of our favorites right now are skyrocketing. Gold, 3,085. To me, it's getting extended. And it's not just because, obviously I already thought we'd probably sit around 3K for a little bit. But the problem is the media is on top of this. we've loved gold for 2 years plus. And we obviously thought 3,000 with our initial target, fantastic. And 3,600 is our second target. And don't get me wrong, I'm still bullish on gold. But when you start to get these types of signals, they do show exhaustion. So I wouldn't be so much FOMO all over gold, although the media would tell you to buy it, and everyone's upgrading across the board. Remember, literally some funds, and this is some big banks as well, are now downgrading the US and putting 5,900 targets on at the end of the year. And they had, of course, before this, 7,000 targets and stuff like that. More on that coming up in the next couple of shows. I mean, there are all sorts of shenanigans going on. Follow the price action, follow the flows, and obviously follow the structure, which is what we'll be doing. Silver, looking a lot better still, doing a good weekly close. We obviously like silver on this channel at this stage. And so far, so good. This market seems to be still ready to continue up. And we'd like to see 45 an ounce on silver moving forward throughout the year. So that would be pretty sweet if that could happen. Tesla hit the weekly 50 moving average, which is this blue line, hit 288, 290. I thought it might reach 295 before selling off, but it's still holding actually surprisingly well in between. No real updates there. And obviously Nvidia needs to be watched. Nvidia. Look at this. Going under the most traded zone again, which is 115, back to 110. Oh, it's starting to get a little bit shaky out here. And of course, you need to be watching semiconductors versus SPY as well. Because as you guys know, we're basically in an oversold signal here, but we need this to recover. Because if it kind of keeps fading here, that's showing that we're going down to this 0.35 ratio, and that's showing a 15% style correction, if not way more. So you don't really want that to occur. 2050 cross. There's nothing here that looks bullish yet, except for I've got oversold signals. So of course we'll have to watch that. The Magnificent 7 as well dropped off. No new low yet, but obviously some stocks stock sectors such as XLK, etc., as you can see, form new lows. And all of this really means that we must find a bid. Before you almost have to focus on patience, react, don't predict in this case. Unless you're a position-based buyer and you know what you're doing, you're going to have to actually see some form of bid, because we have lows on tech stocks. So we obviously need those to start showing rallies. Now, comparatively to all of this, the defensives have been holding very well. XLV's holding very well. And you can see versus the S&P, it's actually outperformed this year. And that just shows you this year is about rotation. We knew it was. We had a very big suspicion it's a rotation. And that's because we're going from mid-cycle into late cycle at an accelerated pace. So basically these tariffs and concerns about administration change stuff are causing this market to go at speeds that you wouldn't usually see. Now, what about HSI? Chinese stocks, we still think they're in a holding pattern for now. So we'll keep updating those after hitting our TP zone. And of course, NASDAQ, as you can see here, a horrible weekly close, right on the lows, closed right near the end. I mean, it's kind of pointing towards 18,400 really at this stage. There's nothing much that you look at and you go, wow, that's fantastic. Not yet. Unfortunately, there's nothing much there that we can see. The mag stocks were showing excellent signs the other day, so I'm not necessarily concerned about them. We knew that we may form a new low, but at the same time, there's no bid here across any of these markets, including the US 2000. Now, to make matters even worse, crypto was ahead of even bigger problems. Of course, supposedly hackers selling their Ethereum and dumping huge swathes of money into the markets, causing, of course, some liquidity problems. And that was only just the tip of the iceberg when you think about what it means. Hackers selling their positions and cashing out, not great. We also, on top of that, have a whole bunch of Ethereum positions sitting just underneath 1800, which again is not a good issue if they're going to liquidate those. So now the good news is that we're starting to build at least some form of structure. We make a new low, we get above 21.15, all of a sudden we have buy signals starting to appear in the markets. So we are starting to build structure. If you're going to take a positive, that would be the positive. What about Bitcoin? It held a lot better, 82,000, obviously sold considerably, but still around that kind of area that if you put something like a fixed range volume profile in, you'll see it's in that kind of most traded range, as you can see here. So still, I would say, right on kind of where you need to see it find a bid. So we're still okay, although things are, still a series of lower lows and lower highs in the higher time frames. So the higher time frames, they're bearish. Lower time frames, it's holding where you'd like to see a bull kind of come back through. Now, for the week ahead, there are a few bits of information you'll want to be looking at. Obviously, there are daylight savings times changes that you may need to be aware of, especially if I think you're in Europe. And then we have the ISM manufacturing PMI coming out Tuesday, the 1st of April at 10 a.m. New York time. Now, on top of all of this, we also have the jobs numbers coming. And as you guys know, the jobs numbers are arguably the most important stat we're looking at nowadays to show whether we're going into a recession or not. And it's expected that, of course, there will be still jobs growth according to the non-farm payrolls. That's Friday, 8:30 a.m. New York time. This will be the one. And as you'll notice, oh, look at all our Fed chairmen, Fed this member, Fed that member, everybody else is coming out, and they're going to have a nice little chat straight after the non-farm payrolls. I wonder why that could be, guys. We see the beginnings of the Fed admitting that they're going to try to do some form of QE. Also interested in your comments down below. We already know they love doing all that stuff. If you enjoyed today's video, then remember to subscribe, smash that like button as well. It really does help us out, guys. And obviously, if you want to learn more about position-based trading, day trading with replication, and more importantly, ignoring this noise and paying attention more to the replication of trading, then check out our 7-day flash sale we've got on right now. Follow us on X, and of course, follow me on LinkedIn as well. Always good to catch up with you guys there and to post more stuff on human psychology, risk management, all that type of stuff. Stuff that you guys might find boring here, but it's actually incredibly important. Thanks so much, everybody, and we'll see you literally during the Monday Open. Bye for now.